This is Horizons Middle East and Africa. Our top stories this morning. Risk off. Futures sink as U.S. President Donald Trump's tariff threats over Greenland revive trade tensions. Gold and silver trade at record highs. Investors await the EU's response to President Trump's tariff salvo, with Germany trying to convince France to avoid using the bloc's most powerful retaliation measure. And we are live in Davos, where we'll be hearing from some of the Middle East's most influential business leaders. It has just gone past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zapasaja in for Jumana Bersechi. And as we just mentioned there, the risk-off sentiment is continuing for a second day over those trade tensions between the U.S. and Europe and Greenland, and potentially what is to come when we do see President Trump in Davos on Wednesday. Let's just take a look at what we are seeing right now across assets. The U.S. comes back online today after the Monday holiday. And if we take a look at where futures are right now, looking potentially poised to start on the back foot right now. S&P futures down just over 1% there. And of course, we are paying close attention to what happens potentially if we do continue to hear some rhetoric out of European leaders about what the implications could be for U.S. assets. The question potentially about the impact on what these tensions mean also playing out in the treasury markets globally, with the U.S. 10-year yield up right now, trading at about 4.26% there. And we're seeing the U.S. 10-year joining in the global bond sell-off. Notably, though, I want to point out what we're seeing in Japan, because we are also seeing yields on the long end also creeping up higher, with the 40-year JGBs hitting the highest since 2007. That is about domestic concerns. We're going to have Winnie Shu dig into that a little bit more in just a bit. As I mentioned, European equities, though, also in focus. We're seeing Euro Stock 50 futures marginally down right now. But of course, Monday was a weak day for European assets. We did see automakers and luxury stocks getting a bit of weakness on Monday. Notably, though, we did see defense stocks, trading with a bit more strength on Monday. So one to pay close attention to. And of course, we have spot gold on the board there, also on the move higher, up just over 0.5% there, following silver to hit another record on those tensions between the U.S. and Europe. Right now, spot gold trading at about $4,696 an ounce there. And really quickly, let's just bring you our terminal chart examining the dollar. It's hard to believe, but it has been 1 year since U.S. President Donald Trump was inaugurated. We are seeing the Bloomberg dollar spot index marginally lower right now, but as you can see from this chart, the initial onslaught of tariffs has left the dollar weaker. And even as we've seen equities slightly recovering over the past few years and hitting new records after, we haven't seen the same with the dollar recovering since Liberation Day. So as we mark this 1 year since the Trump inauguration and now increased tensions between the U.S. and Europe, the question is, where does the dollar go from here? But let's check in now on how markets in Asia are faring. Winnie Shu is in our Hong Kong studio, standing by for more. Winnie, are we seeing the negative sentiment playing out similarly in Asia? What do you have on the board there?
Yeah, exactly, Jen. We are seeing that losses extending for a second day in our region, with the MSCI Asia here down about 0.5%. And leading losses here are the technology shares. As you can see, that the tech gauge is down 0.8%. Overall, across benchmarks, all in the red, from Japan to China to India. However, one outlier that I have to point out is still Korea's Kospi index reversing losses again, just like how we saw things turn out yesterday, and to rise up 0.3% here, and it's up for a 13th session by now. I know that I probably sound like a broken record here every day, but we are very closely watching for that benchmark to reach that 5,000 target, and that we're just about 1% away from that. Now, flip the board and take a look at what's going on in the Japanese market. As you point out, a lot happening there. In terms of stocks, Nikkei 225 here down more than 1%, and yes, Prime Minister Takaichi did confirm that snap election to come next month. However, we are seeing a bit of a profit take in terms of that Takaichi trade rally, and also some say that a bit of a concern when it comes to kind of just how Takaichi is not didn't sound as confident at the presser yesterday. However, for now, those concerns around kind of the fiscal spending and the government spending more is weighing on the bond space. As you mentioned earlier, that the 40-year yield actually crossed that 4%, first time since its debut in 2007, while we did see the weakest 20-year bond auction since the weakest demand since more than a decade. And that's also weighing on the 20-year yield here, with yields up 15 basis points to the highest since 2000. And overall, Japanese yen also still hovering around that 158 level against the dollar. Back to you, Jen.
Yeah, quite a lot of activity there. Winnie Xu in Hong Kong. Thanks so much, Winnie. We'll check back in with you in just a bit. Now back to our top story. German Chancellor Friedrich Merz says he's trying to persuade French President Emmanuel Macron to tone down his response to President Trump's threat to impose new trade tariffs on European allies. Macron is said to be eyeing the activation of the European Union's anti-coercion instrument. But German Finance Minister Lars Kleinbiel is still urging European leaders to stand up to Trump's threats.
We are constantly experiencing new provocations. We are constantly experiencing new antagonism, which President Trump is seeking, and we Europeans must make it clear that the limit has been reached. All of this shows what a period of upheaval we are currently living in. The logical consequence for me is very clear. We must make Europe stronger. We must do so much faster than is currently the case.
Joining us now is Bloomberg's Brian Fowler for more. Brian, we just saw there one reaction to the threats by Trump, but is it fair to say that we're seeing a unified response and rhetoric coming out of Europe right now?
Well, Jennifer, I think the answer is yes and no. On the one hand, all the officials we've heard from condemn Trump's steps. We heard from officials in Germany just now and also in Sweden, France, and the UK, and they've all made comments to that effect. In recent days, the EU will hold an emergency meeting in Brussels this week to discuss retaliatory steps. But for now, one thing that you can say is that the bloc is unified in its willingness to defend Greenland and Denmark in this situation. At the same time, the degree of retaliation, how aggressive the bloc should be, I think there's some variance there. France's Macron, we just alluded to it, wants a very aggressive stance, and so does Sweden. They both want those measures to go against that counter the steps from Trump. And we also had kind of a mixed response from UK Starmer. On the one hand, he said what Trump is doing is totally wrong. At the same time, he said he wants to use a diplomatic solution till the very end. And just now we had Germany. I mean, Merz wants to rein in Macron, but his finance minister is also looking for those strongest retaliatory steps possible. So it'll be interesting to see what they decide to do in Brussels this week.
It's a bit of a spectrum of potential measures. Brian, what could the potential impact be, though, if we do see potentially some of the more aggressive measures like the ACI taking place, or in fact not as aggressive?
Yeah, so the Trump threat is a two-stage one. First of all, for those 8 European countries that would get a 10% duty from February 1st, the impact of that would probably be manageable, rather minimal. But those duties would go to 25% from June, and that could have a much bigger impact. Bloomberg Economics estimates that the shipments to the U.S., exports to the U.S. from the affected countries could fall by up to 50%, with the biggest impact landing on Germany and Sweden and Denmark.
All right, we'll leave it there with you. Bloomberg's Brian Fowler, thanks so much for starting us off. Let's continue the conversation. My next guest says geopolitics remains a key risk in 2026 as the world becomes increasingly fragmented, as we've seen over the past few days. Joining us is Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute. Ben, thanks so much for joining us. So quite a bit of risk we're already seeing play out in 2026. What do you see as potentially the next key risk event to pay attention to, potentially continuing to put pressure on risk appetite more broadly?
Yeah, good morning, Jennifer. Great to be with you. It's a very busy time in financial markets and perhaps in life more generally. So what we would stress from the perspective of the BlackRock Investment Institute is to try and stay, as investors, try and stay relentlessly focused on your core convictions. So for us, that would include the ongoing artificial intelligence boom, a few other themes that I can get into. But the game, we think, with geopolitics, of course, it's super important, very, very interesting. But it's not immediately obvious how that will negatively impact, for example, chip demand. So we would try and stay focused on our core convictions, very, very mindful of the geopolitics, but try not to get scared out of those core convictions while acknowledging, frankly, some of the headlines are a little bit unsettling.
Can you talk about some of those core convictions for BlackRock, Ben? You mentioned AI, but is there anywhere in the market where the firm is intentionally not diversified, just considering a lot of the uncertainty right now?
We'd always want to be diversified. We'd always want to have that blended benefits of risk and reward. Artificial intelligence, interestingly, does seem to be, in some sense, diversifying itself, by which I mean we're seeing AI now ripple through markets beyond purely the Magnificent Seven. So we're seeing that by geography. You can think about Korea, the world's strongest performing market last year. There's a memory shortage, which is at least associated with the AI super boom. We're also seeing copper prices do very, very well over the last couple of months, which I think, again, you can draw a reasonably straight line between AI, the likely demand that leads to for electricity, and then copper. So I think AI continues to be the story of our time, but we need to be very nuanced. It's not good enough just to be bullish AI. We are bullish AI, but we need to be much more specific and focused on exactly what that means. And it isn't just the Magnificent Seven. You can diversify within the AI theme across geographies and even across asset classes.
Yeah, and we've seen some sector breakdowns as well. Ben, I thought it was interesting in your notes because you pointed out that gold is not a reliable long-term hedge. We have, of course, seen gold continuing to hit more records. Can you just spell out that argument for us?
You're exactly right. Gold continues to perform very, very well, I guess, playing its traditional role as both a hedge against so-called debasement risk and geopolitical uncertainty. And it seems we've got a little bit of both vis-a-vis concerns about the end of US exceptionalism. Perhaps those are overstated, but they're in the air. So those concerns multiplied by geopolitical problems means that gold is doing what it's done probably for the last 6,000 years, which is at least preserve its purchasing power. That's likely to continue. We would say, and this was the point you picked up on, it is possible to have too much of a good thing. So we wouldn't want to be overly focused on gold. It can play a role in a portfolio, but again, we would stress the importance of diversification and keeping your core conviction longs in areas like AI, as I mentioned.
But Ben, you also noted that you're underweight long-dated treasuries. If you are, in fact, potentially a bit concerned about where the sustainability of the gold rally, and longer-dated treasuries, where do you find hedges in this current environment?
That is, I think, one of the most important questions of our time. It's really hard. I'll try and answer shortly, but just to take the premise of your question and really hammer the points. We can't just chill out with a traditional 60-40 portfolio. That's not going to get the job done in a much more fractured, complicated world where there are concerns, including in the world's so-called risk-free assets. US Treasury yields, we think over time, long-term yields likely to go up, which is a little bit of a headwind. So we're going to need as investors to be much more active. We're all going to have to work a lot harder to think about specific pockets of risk and resilience that we want to target, because unfortunately, just doing it the way we've done it for much of the last several decades, we think is not fit for purpose. And we all need a new investment playbook to kind of accurately reflect what is a much more complicated and volatile macro environment.
What would need to happen, though, for you to change that view? Is there anything that could happen that could change that viewpoint?
I guess if we were to see an end of the volatility, geopolitical stability, no concerns on inflation, we would change our views accordingly. Sadly, the evidence seems to be in the other direction, the kind of fracturing of the world geopolitically, the uncertainty around policy, that seems to be increasing, not decreasing. So for now, our convictions remain highly convicted.
Ben, fascinating insights. Really great to get you on the show today. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joining us there. Thanks so much, Ben. Now, for a look at some of the other stories we are following today. French Premier Sébastien Lecornu is to use Article 49.3 to adopt the 2026 budget without a parliamentary vote. The moves come after months of talks with opposition parties failed to yield an agreement. Lecornu will likely face no confidence motions, but socialist lawmakers have indicated they're ready to abstain and allow the government to remain in place after he made concessions on tax and spending measures. And Federal Reserve Chair Jerome Powell is planning to attend Wednesday's Supreme Court hearing over the attempted dismissal of Fed Governor Lisa Cook by President Trump. The Supreme Court in October refused to allow Trump to immediately oust Cook while she sues to keep her job, allowing her to remain in her position until the justices rule. Now, coming up, we hear from the UAE's Economy and Tourism Minister on how the Gulf nation is looking to strengthen diversification and dialogue. That's next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The UAE's Economy and Tourism Minister says the country is responding to economic fragmentation and rising protectionism by strengthening diversification and dialogue, with non-oil sectors now making up around 3/4 of GDP and growth of about 4 to 5% expected this year. Speaking to Bloomberg's Jumana Bersetchi in Davos, Abdulla bin Touq Marri also highlighted strong foreign investment inflows and the expanding role of tourism as central to the country's economic resilience.
UAE have attracted about $42 billion worth of FDI inflow into the UAE. We've grown from 19 billion 3 years ago up to 20, 30, $40 billion worth of FDI inflow in the UAE. So UAE has been an attractive magnet in the region as well for investments to come in the UAE, to look at the UAE opportunity. We've seen the growth of companies from 5 years ago, from 600,000 registered to now 1.4 million. And we are expecting to reach 2 million companies registered in the UAE in the next couple of 6 to 7 years. But that's kind of the growth. They believe in the UAE's vision, believe in the UAE's economic model, believes in the kind of aspect that the UAE is doing something right. Yeah. And I think the more important aspect is from, like I said, the company law to the CEPA signings to the reform into the immigration policies, the golden visas, for instance, have really transformed that. And tourism is, of course, tourism today represents about 15% of the UAE's economy, GDP, and that's when we show that UAE can go as well more than 17 to 18% of that in tourism. Today, the occupancy rate in UAE's hotels goes up to 78% on year-round. That's one of the highest in the world.
That was the UAE's Economy and Tourism Minister speaking to Jumana Bersetchi in Davos. Now, coming up, Mubadala CEO says the Abu Dhabi Wealth Fund has a lot of conviction in artificial intelligence, despite investor concerns about exuberance in the sector. We have more on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Mubadala's chief executive says the Abu Dhabi Wealth Fund has a lot of conviction in artificial intelligence, despite investor concerns about exuberance in the sector. He spoke with Jumana Bersetchi at Davos.
The markets have been very interesting in the sectors we like, in the geographies we like. We've been working hard since inception to get Mubadala to where it is today. And I think over the last 2 years, we've really cranked it up as an organization, as an institution. And 25, I think we deployed anywhere between $35 to $40 billion in terms of investments around the world. We've had a lot of monetizations also. We've effectively monetized probably the same amount, around 35 to 40 billion also.
What about the sectors you like going into 2026? Is it the same pretty much playbook that you looked at in 2025, or are things going to be a little different?
Yeah, I think our trajectory in terms of sectors over the last couple of years has been pretty consistent. I think we've taken a very strong view on artificial intelligence, on AI, the entire spectrum of technology. I think that's an area Mubadala has been really spending a lot of time on. So that continues to be the case. I think on the infrastructure side of it, digital infrastructure, that remains, again, a very core area for us. Healthcare, consumer, financial services, credit. These are, again, areas which have performed extremely well over these last couple of years. And I think going forward, we continue to be pretty convinced of these spaces.
There's a lot of talk, as you see, you're watching Bloomberg, I'm sure, you see a lot of people talking about too much hype or over-exuberance in the ecosystem of artificial intelligence. Has it made you have to be a lot more discerning about where you're looking for value and for growth and for scale in this space?
No, I think the space, we have a lot of conviction on that space. I think leaving the noise and the hype aside, I think we have a very clear view of what we think are the investable spaces within the technology space, where we think, particularly when it comes to AI enablement, there's a lot of aspects that I think we believe in, we've invested well in, I think we will continue to invest in, and I think the growth continues to be high in that area.
That was Khaldoon Al-Mubarak, the CEO of Abu Dhabi Sovereign Wealth Fund Mubadala. Now, for a look at some of the other stories we are following today. Qatar's wealth fund plans on taking a more selective approach to artificial intelligence, focusing on investments that can deliver real productivity gains. Speaking in Davos, Chief Executive Officer Mohammed Al-Sawaidi said AI will be a key driver of long-term economic growth.
What we yet to achieve and observe very openly is that AI would actually bring fundamental growth on the level of productivity. And you will find economies that don't really utilize AI in the right way, or industries, they will fall further behind. So it's a long-winded answer. I think geopolitical risks are real, but I think ultimately over the long term, the more fundamental drive to the future growth would come from AI overall.
Libya has signed a multinational partnership to develop and expand the Misrata Free Zone port on the Mediterranean. The project involves Qatari, Italian, and Swiss companies and hopes to attract about $2.7 billion in investment. The expansion aims to boost the terminal's capacity and create thousands of jobs. And the United Arab Emirates and India have agreed to deepen economic ties with plans to double bilateral trade to $200 billion by 2032. As part of the deal, the UAE will supply India with LNG under a 10-year contract and invest in a major development hub in Western India. The two countries also agreed to deepen defense ties. And coming up, we discuss the mood in Davos as President Trump's tariff threats and the risk of transatlantic trade war overshadow the annual gathering. We're live in Davos next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Risk off, futures sink as U.S. President Donald Trump's tariff threats over Greenland revive trade tensions. Gold and silver trade at record highs. Investors await the EU's response to President Trump's tariff salvo, with Germany trying to convince France to avoid using the bloc's most powerful retaliation measure. And we are live in Davos, where we'll be hearing from some of the Middle East's most influential business leaders. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zabasanja in for Jumana Bersetchi, and as we were just mentioning there, we are continuing to see the risk-off sentiment continuing into a second day, and we're even getting some indications now it could continue as we're hearing more from U.S. President Donald Trump on Truth Social. He has indicated that he'll plan to meet very various parties over Greenland in Davos. He, of course, is going to be heading there later today, maybe tomorrow. And he did have a very good phone call and also says that Greenland is imperative for national and world security and indicates that there can be no going back. So the question is, how does this play out in the markets? If we just take a look at where U.S. equity futures are, the U.S. comes back online today after the Monday holiday, and it's looking like potentially it's poised to be a negative day. S&P futures down more than 0.9% there, and continuing to follow what this means for the global bond market. We are seeing potentially the impact on these trade tensions playing out there, at least with the U.S. 10-year yield rising right now, up right now to 4.26% there. Notably, we're also paying attention to what is happening in Japan. There is a bit of movement on the long end with yields rising. That is, of course, more to do with domestic concerns, but still we are seeing a global bond sell-off right now. Eurostock 50 futures a bit flat right now, but still watching closely for what Tuesday looks like for U.S. equities, especially as these tensions continue to percolate. Citigroup actually saying that these tensions have led to them downgrading European equities for the first time in a year. And let's just finish on gold, also moving higher right now, up about just over 0.6% there, hitting above $4,700 an ounce there, spot gold there, and continuing to watch a bid for safe havens as we see geopolitical tensions continue to rise globally. Now, let's just take a quick look at our terminal chart. It has also been 1 year to the day since U.S. President Trump was inaugurated. We're seeing the Bloomberg dollar weaker on the day, but still, this chart is showing that although we have seen equities recovering slightly since Liberation Day, the dollar hasn't followed the same path. And so the question is, how do these continued trade tensions between the U.S. and Europe, how does that play out in the currency markets, and especially with the dollar? Let's check in, though, on how markets in Asia are faring. Winnie Xu is in our Hong Kong studio following that. Winnie, what are you watching this morning?
Yeah, so we continue to see that weakness in the Asia session, especially driven by these overall risk-off sentiment. Now, technology shares are overall leading those losses, but we are seeing across benchmarks, it's all pretty much in the red. Chinese stocks still losing momentum into this year, especially with regulators coming in to try to cool the market. But also, the outlier here really is still Korea's Kospi index rising for a 13th session. When it comes to Japanese stocks, the Nikkei 225 here down about 1% and actually is down for 4 sessions already. And there is obviously some of these profit taking after that Takaichi trade driven rally, but also investors are flagging some concerns in terms of how Takaichi did not sound very confident at her presser yesterday. And yesterday, yes, she did confirm that snap election to come next month. As you flip the board and take a look at how these bond yields have been spiking on that, as you can see on our terminal chart that across the different maturity, it has really been going up since Takaichi took office. And right now we are talking about the 40-year bond, actually the bond yields passing that 4% level, and now is at its highest since debuting in 2007. And we also got very weak bond auction results when it comes to the 20-year JGB auction today. And we are seeing those yields also spiking to the highest since 2000. So overall, still those concerns when it comes to the fiscal budget and also the government spending. Back to you, Jen.
Yeah, quite a busy day in Japan. Winnie Xu in Hong Kong. Winnie, thanks so much, as always. Appreciate it. Let's pivot back to day 2 of the World Economic Forum's annual gathering in Davos. It begins. U.S. President Donald Trump's tariff threats and a possible transatlantic trade war is dominating conversations. Horizon's anchor, Jumana Bersetchi, is there for us and is joining us now. Jumana, so Trump setting the scene for what he calls an extraordinary gathering. What are you hearing on the ground there as people prepare for him to arrive?
Look, I've got to be honest with you, it's wait and see mode. As ever, the conversations, the narratives, everyone is waiting to hear and see President Trump when he gets here later this evening. A massive U.S. delegation. It should be noted that this is the largest ever U.S. delegation that's descending on Davos. He's bringing basically the full administration with him. Secretary of State, a trade representative, a special envoy to the region, to the Middle East as well. And then Trump himself will be giving his inaugural speech tomorrow. That is on Wednesday afternoon. And as you know, with these speeches, they could really go anywhere. He could decide to focus on the domestic economy. He could spend a lot of time speaking about updates on the Greenland situation. Just now, he put up a post on Truth Social saying he did have a good call with the NATO Secretary General, but also that there is no turning back. And then when it comes to the region as well, our region, last week, there was a lot of conversation about whether they might do anything in Iran. Is that also going to feature in the speech? Is he going to have anything to say about this newly established Board of Peace? And we know that certain leaders around the world are pushing back on some of the terms of that Board of Peace. So yes, there is a lot at stake from the U.S. delegation arriving to Davos. But I should also say that the theme of this year's forum is actually a spirit of dialogue. So where does that all fit in? And the fact that this time around, you essentially have one chief agitator around the world that's upending the global world order. And long gone are the days where you would come to Davos and top of the mind would be topics like stakeholder capitalism, sustainability, environmental matters, social justice, anti-corruption. It feels as though a lot of those themes have actually been put to the side in favor of this new world order that is being ushered in by President Trump. So similar to last year, because it was a few days after his inauguration, I think all eyes will be on that speech tomorrow.
Right. And Ziemba, you've been having a number of great interviews there on the ground. Just considering some of those points you just mentioned there, how are investors, taking this? Is there already a pivot away from the U.S. or are they still in a wait and see mode?
I think probably the knee-jerk reaction is some people may want to go back into that sell America trade. There was a lot of talk overnight about potentially Europeans going down a more aggressive approach, using one of their anti-coercion tools. But when it comes to Middle East and our part of the world, you heard from the conversations that we had that U.S. is still a very attractive destination from a technological perspective, from a growth, productivity perspective. And there is still a fundamental belief. I mean, there was a story up on the terminal yesterday saying that essentially the C-suite in the U.S. and Wall Street have rallied behind President Trump because they still believe fundamentally that he's going to pursue a pro-growth agenda. Let's listen to some comments from His Excellency Khaldoon Mubarak, who is the CEO of Mubadala. And it should be noted as well that Mubadala were one of the most, actually they were the most active sovereign wealth fund last year. And a lot of that investment has gone into the U.S. Here's what he said.
Well, let's start with the first word you used, the UAE. The UAE is a very important aspect of our portfolio. Of course, we are based in the UAE. We are owned by the government of Abu Dhabi. We have a significant aspect of our portfolio in the UAE. And last year was an exceptional year for us. We had north of 20% returns in our UAE portfolio across real estate, infrastructure, industrials, technology. So it's been a very healthcare, very strong year for us in the UAE, and I think the UAE is well positioned for growth. I think going forward, and we're well positioned to take advantage of that as significant investors in the UAE market. The U.S., of course, is the largest market. Is where we've been significantly invested over since inception. It remains our largest market in terms of, particularly in the sectors we're focusing on, technology. 25 was a good year. 26, I think we will continue to invest. You talked about the commitment made last year. I think for us, it's business as usual in the U.S. We know the U.S. market. We know how to invest. We know where to invest, and we have the right partners to invest with there.
What about Asia? What opportunities are you seeing there?
I really like Asia. I really like Asia. Over these last 10 years, we've been starting from a weak point as a portfolio. We were undervested in Asia. I've focused a lot, I think, as an organization in Mubadala towards building our knowledge in Asia, understanding the markets, and then focusing on the sectors we like most. We've done that. Today, we have a very strong operation in China. We know the markets in Southeast Asia well. 2025 was strong in Korea, Japan, China. All these markets we've done very well in. Yeah. So I think it worked very well for us.
So there you heard it from Mubadala, the most active sovereign wealth fund last year, saying for them it's business as usual, and that essentially there's the signal and there's the noise. And perhaps for many of these Wall Street executives, for many of these investors, you have to cut through the noise and figure out what exactly the Trump administration is trying to achieve, and the growth prospects for the U.S. economy. Sectors like AI, tech will continue to dominate, will continue to attract a lot of interest, no least from our part of the world as well. So yes, there is a lot at stake for the global economy and also for geopolitics this week. But at least from the conversations we've had, there seems to be a belief that U.S. exceptionalism is far from being over.
Really great stuff on the ground there, Jumana. And it's only been one day. Looking forward to more of your conversations. Bloomberg's Jumana Bercetchi in Davos. Jumana, thank you so much for joining us. And coming up, President Trump's Greenland-related tariff threats reignite trade tensions with Europe. We'll get the view of Rachel Ziemba, founder of Ziemba Insights, next. This is Bloomberg. Tensions between the U.S. and Europe are escalating, with the European Union weighing retaliatory tariffs on U.S. goods worth more than $100 billion after President Trump threatened new levies tied to Greenland. He spoke a short time ago ahead of his trip to Davos.
Well, I don't think they're going to push back too much. Look, we have to have it. They have to have this done. They can protect it. Denmark, they're wonderful people. And I know the leaders are very good people, but they don't even go there. And, you know, because the boat went there 500 years ago and then left, that doesn't give you title to property.
Now, some investors are speculating whether Europe could use its trillions of dollars in U.S. asset holdings as leverage in response to Trump's renewed tariff threats. Joining us is Rachel Ziemba, founder of Ziemba Insights, to dig into all of this. Rachel, thanks so much for joining us. So let's just start there, because European countries are some of the biggest holders of U.S. assets. Do you think there is the potential here for Europe to use this as potential leverage? What is at stake here in the current situation?
Thanks, Jen. Always a pleasure to be with you. I think they're unlikely to use it as leverage per se. As you say, large pension funds in Europe and sovereign investors like the Norwegian Pension Fund Global are some of the largest holders of U.S. equities and treasuries in the world. I think what is at risk is this investment going forward, as the United States proves itself to be a less reliable partner and maybe, outside of certain tech industries, a less reliable source of investment. And I mention that not only on the strategic point of view, but also we continue to see uncertainty about tariffs, uncertainty about tax treatments for some of these investments. And so I think we had a point last year where some large investors looked around and said, maybe we don't want to have such large unhedged positions in the United States, and we might see a further move in that regard going forward. And in addition to this portfolio investment, European companies are some of the largest providers of foreign direct investment in the United States. And that was something negotiated in the trade agreement in Turnberry, middle of last year. I would imagine some of those projects might be on hold or in question, as I say, not only because of Greenland, but also as there is more pressure to invest in defense and industry and other aspects, even in Europe. There aren't a lot of alternatives that are as deep as liquid and as liquid as the U.S., but I do think this question mark lingers about what both the returns are, but also, other investment risks.
Well, and also what this signals potentially for NATO-style alliances around economics. Does this signal potentially a continuing breakdown of what this looks like?
I think it does. It sends this message that NATO guarantees are practically worthless in a sense, that if the Trump administration needs to own an asset or have it be U.S. property to defend it, it raises all sorts of questions about what if Article 5 was triggered, and it could create even more opening for countries like Russia or even China to look to seize other assets. And it, I think, will also create an environment in Europe where the sensitivities around imports of energy from the United States will be looked at a little more closely, having swapped a dependency with Russia or to a dependency, at least more so with the United States. We might see some attempted diversification with regional partners like Qatar, perhaps having a little more leverage to set terms in exports to Europe.
And Rachel, I just want to finish on the energy sector, because you did point out what's been notable happening at the same time. Syrian forces took control of oil and gas fields. Does that potentially play out in the oil markets right now? We aren't seeing that much movement. I wonder how you're interpreting some of the price action.
Yeah, I wouldn't expect Syria to move the markets much anytime soon. Even at its peak before the civil war, it was a very small producer. But Syria is very important for regional stability. And a weak Syria, one that was returned to fighting, could undermine other regimes in the region. In terms of impact on oil, I'm really watching what happens vis-a-vis Iran, where things, as Jumana said, have been cooling down from a U.S. perspective and since the last week. How much new supplies come on from Venezuela, and maybe more realistically, as the market digests the losses from Kazakhstan, which are really a function of Ukrainian drone attacks. So overall, to the extent that there is consolidation of government forces in Syria, and Syria could begin to welcome some more investment in production, that, in my mind, is a good thing, but it's a long-term play. And it may be more important for both regional stability and economic outcomes in the region than necessarily the oil market.
Your analysis is always valued. Rachel Ziemba, founder of Ziemba Insights, joining us there from Dubai. Thank you so much, Rachel, as always, for joining us. Now, coming up, we turn to the region here. Zambia becomes the first African country to let Chinese mining companies pay taxes in yuan. We'll bring you that story next. This is Bloomberg. Investcorp's executive chairman sees an improving outlook for IPOs in Gulf markets. Speaking to us in Davos, Mohamed Alardi says he believes the region offers a very compelling long-term investment market.
The IPO market is improving in the Gulf for sure. I mean, Oman, for instance, was one of the high growth markets last year. But I think even globally we see an improvement in IPO's market.
Now let's pivot to the region. Zambia has become the first African country to allow Chinese mining companies to pay taxes in yuan. The move highlights Beijing's broader push to reduce reliance on the dollar and expand the Chinese currency's role across Africa. For more, we're joined by Bloomberg's Matthew Hill in Cape Town. Matt, you've dug into this quite a bit in your own reporting. How significant is this latest move?
Hi, Jen. Well, for Beijing, it's a noteworthy move in President Xi Jinping's move to internationalize the yuan. And just to look at how the mechanics of this work in Zambia, it all starts with copper. Zambia is Africa's second biggest producer of copper. China is the world's biggest consumer of copper. And China also happens to be Zambia's biggest bilateral creditor. So what this means is that Chinese mining companies in Zambia can sell their copper to buyers in China and receive yuan. take that yuan and pay their royalties and taxes to the Zambian government, which then will use that same currency to service its debt to China. So it effectively cuts out the middleman of the dollar, reducing transaction costs, etc. So it basically slowly but surely chips away at the use of the dollar.
And Matt, if we just take a zoom out of just Zambia and take a look at across the continent, the potential for this, given the yuan's limited convertibility, it's still only less than 2% of global reserves. I mean, how much could the continent really contribute to China's influence with the yuan?
Well, Jen, this is just the latest move in a growing trend that we've seen in Africa, where governments are showing increasing interest in using the renminbi. Last year, we saw Kenya swap its dollar debt to China into yuan. We saw Ethiopia saying that it started talks to do the same. And Afrex, the African Export-Import Bank, also last year sold its first Panda bond. Zambia itself is talking about a currency swap with China. We've seen a number of other African countries doing the same. And when you consider that China's Belt and Road Initiative reached a record $213.5 billion last year, with Africa being the biggest part of that engagement, it's no wonder that we are seeing a growing engagement and integration between the Chinese and African economies, including currencies.
Yeah. Right. And Matthew, you noted that President Hakainde Hichilema, his advisor, is saying that potentially the yuan can help insulate the nation from U.S. policy shocks. Interesting reporting there. Bloomberg's Matthew Hill, thanks so much for your reporting. Let's just take a quick look at where markets are. Risk off, as we mentioned, as continuing trade tensions between the U.S. and Europe play out. The U.S. is back online today after a holiday. And as you can see on the board there, futures looking negative to start Tuesday. That is it for Horizons Middle East and Africa, though. I'm Jennifer Zabasaja in Johannesburg. Stick with us for Daybreak Europe. This is Bloomberg.